Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guest for today is Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome to the Open Treasury podcast, Craig.
It's good to be here, Push.
This week, we are focusing on 7 stories that cover 7 themes: Russia and SWIFT alternative, multinationals rethinking China risk after Taiwan tensions, UBS moving towards AI, China lowering lending rates again, BlackRock's warning that new ESG rule could hurt investors, drought impacts on China's economy, and finally, drought on the Rhine that is threatening the German economy. You can read these articles and also research content more deeply by visiting CTMfile.com or by following the links in our show notes. Craig, let's begin our discussion with the first section that revolves around Russia proposing its alternative to SWIFT for trade partner transactions. In this connection, Moscow has invited members of the Shanghai Cooperation Organization to join its financial messaging system, SPFS, the Russian equivalent of SWIFT, to increase the volume of settlements in national currencies. Russia's economic development minister has pointed out that the SCO countries must continue to push for complete national payment system interoperability and increase the number of cross-border payments in domestic currencies. Craig, do you think Russia's homegrown alternative to the SWIFT payment system, particularly its invitation to the 8 members of SCO to use it for cross-border payments in domestic currencies, can cause disruptions in the global payment system and the dollar's dominance in the long run?
No, I don't. I think that they're pushing that for a good reason. I mean, a decade ago, their invasion into parts of Ukraine and absorbing them, and then more recently attacking Ukraine, there's been significant fallout from sanctions, removing them from payment messaging networks like SWIFT. They've been on for a decade, they've been pushing to have some alternative to this so that they can avoid some of the sanctions. So the power of a network is, how big is it? What can you do on it? And how does it work? And one of the items that you talked about is that they wanted interoperability with the in-country payment systems. Every country has an in-country payment system, usually managed through their central bank. And then if you connect to this network, it prints out on a screen or prints out on paper or screen and someone types it into the in-country network. It has to be quick, efficient, lacking this manual handoff. And so that's really what they're trying to do. They're trying to get an efficient process on an end-to-end basis. So the issue is you've got to get enough people on it. You've got to get full interoperability on the in-country system, which is what everyone has with SWIFT. So they're trying to replace that. But no, I don't see that as replacing either SWIFT or the strength of the dollar, in any near term. Certainly there's going to be ongoing challenges to that, but this is not enough. And how many people want Russia to lead that? There's a limiting factor there.
Moving forward to the next story, where multinationals are rethinking the China risk after Taiwan tensions. Multinational companies are reported to be developing contingency plans in the event of a US-China military conflict after Beijing recently launched an unprecedented series of military exercises around Taiwan. The intensified planning by business leaders in another developed economies indicates that investors in China no longer consider an invasion of Taiwan to be merely a low probability black swan risk to the world's second biggest economy. There's a lot of scenario analysis and thinking going on, according to the head of the EU Chamber of Commerce in China, all the way to what should we do in case there is war? Should we close our China operations? How can we sustain our business and overcome possible blockades? 2022 is not just another year of challenges for Treasury professionals. It is a year with daunting array of challenges, ranging from cybersecurity threats to currency volatility, interest rate hikes, inflation, the global energy crisis, and now simmering tension between China and Taiwan. Assessing challenges and managing unknowns and uncertainty in an unpredictable world is fraught with risks. Craig, in the light of the China-Taiwan heightened tension, my question may be a little different from what you were expecting. Do you think Treasury professionals can reap a lot of benefits from using sensitivity analysis and scenario analysis together, particularly to get a comprehensive view of potential outcomes and diminish their risks? Or do you believe a standalone analysis like scenario analysis that is being done by multinational corporations to develop prudent contingency plans can abet decision making?
Well, certainly looking at different scenarios is wise, prudent, and some of the methods of calibrating that will and should come into bear for organizations, particularly as they're exposed to Taiwan, the availability of some of the chips that they provide, and or China, if that's your primary or sole focus source for goods in your supply chain. So that's an easy yes. How far it goes, that's a harder question. As we look at the Taiwan tensions, I think there's more attention paid to this because, this idea of a status quo, China views Taiwan as part of their one China policy, but it operates independently across the strait. There's a policy of kind of ambiguity on the part of the U.S. that supplying arms, not taking a position in certain ways and remaining ambiguous neutrality is a component of that. We look at what happened with Russia's second invasion of Ukraine that's been going on since earlier this year. What happened? There was a huge departure of companies, Western companies, leaving Russia. There was a view that the economic influence and sanctions weren't influencing what their actual behavior was, presents a risk, and makes it not worth operating in Russia. So hence a huge number have left. But what has happened in Russia? What are they doing? They're playing with energy into Europe, turning the pipeline off for repairs or ostensibly whatever the issues are to flex their muscle. Part of the trade that they have is energy. And so they're using that to their full extent. And so, looking at what can occur with China and Taiwan, I think people are looking at, say, single source from, a country like China who's continuing to ramp up their military capabilities, the number of flyovers they have going into Taiwanese airspace, all a prelude, as most people assume, a prelude to one time they turn inland as opposed to just violating the airspace, the identification zone, and then the airspace. What are the scenarios? The idea that you may be deep into China, but you need a secondary source for sure, and that's part of the articles talking about that. Seems quite prudent, both scenario analysis for what that means financially, but from an operational perspective, those types of activities need to be undertaken to protect your organization.
Moving forward to the third story, which is about the Switzerland-based multinational investment bank and financial services company UBS Group investing in Big Panda, an artificial intelligence IT operations platform, though through UBS Next, the firm's strategic venture and innovation unit. Craig, what do you think are the benefits that will come UBS's way through this investment?
If you look at the banks, the trillion-dollar banks, the extremely large global banks that exist, and what they're doing with artificial intelligence, what they're doing with their relationships with their customers, from their wealth customers, their individual consumer customers, to their corporate and commercial customers, there's a long line of these banks investing heavily in AI and machine learning companies and applying that technology. So this is everything from this helps with communication to fraud to forecasting to anticipating needs to cross-selling. This is where banks see a key tool that they need to have. And part of that tool is not just to incorporate it, but to invest in some of these companies to, both leverage their balance sheet, their portfolio, their investment arm to speed this on and help pull that into the organization. So this is one of many. I think this is, logical. You'll see other large banks do this. The largest banks all have, one or more investments in different AI firms. This is not going to shrink or go away. It might become more concentrated, but this is a key area of focus to deliver on their their promise to serve their customers in efficient ways.
The fourth story up for discussion today is the lending rates have been reduced by China all over again following last week's unexpected rate cuts. China trimmed its key lending rates again on Monday, 1 week after it cut two interest rates in a surprise move. The People Bank of China, China's central bank, lowered its 5-year loan prime rate to 4.3% from 4.45% and its 1-year loan prime rate to 3.65% from 3.7%. The moves are seen as an attempt to revive credit demand and fire up the economy hurt by extended COVID lockdowns and real estate debt problems. Craig, do you think the cuts would be enough to increase or inject liquidity into the system and lead to a turnaround in the property market?
Well, the fact that there's been multiple cuts in such a short period of time, including elements of surprise not communicated early, indicates that they have to do something. So this idea that officially China is not in a recession, according to the numbers they publish, I think the various actions that they're taking indicate that that may not be true, that they may already be in a recession. If not, they're certainly concerned about it across a number of these different areas. So to spur borrowing, investing, to get the economy either moving out of non-growth to growth or to a higher level of growth, or what's traditionally been the or more recently been the GDP direction of China. I think these rapid adjustments are telling a story, and they're not the only country that's doing that, but they are the only country that had these large lockdowns for COVID recently. So this is we're seeing what the impact is because they're not great with sharing data and it's not really relied upon. It might be years before we hear what really went on during this time period, but these are a lot of indications of trouble underneath the surface of the water.
Glad you used the word trouble, because from trouble, we are moving to another story where BlackRock's warning that new ESG rules could hurt investors. The world's largest asset manager, BlackRock, warned the U.S. Securities and Exchange Commission last week that its proposed rules aimed at fighting greenwashing by fund managers will confuse investors. BlackRock made the claim in a letter filed last week in response to Wall Street Watchdog's May proposal to stamp out unfounded claims by funds about their environmental, social, and corporate governance credentials. The rules also aim to create more standardization around ESG disclosure. Regulators and activists have become concerned that US funds looking to cash in on the popularity of ESG investing may be misleading shareholders over their ESG credentials. Craig, do you think the proposed requirements would increase the potential for greenwashing and lead to investor confusion?
If people are committed, if companies are committed to increasing their use of ESG instruments, they should be able to do so properly. At the same time, there's this, maybe not at the same time, but we also see there's certain people who promote ESG very heavily. They talk extensively about environmental concerns, and they're flying around in jets and using 20 times, 100 times, 1,000 times the amount of energy and creating more pollution than any normal individual in a Western country and a fairly wealthy country does. And so when you see that and they build their houses right near the ocean, even though they might say, we think there'll be flooding within 10 years, there's people that don't believe it. They say something and don't believe it, and their actions belie that. The point here is that if you want to invest in ESG, it should be clean and good and real, not this greenwashing. Hey, here's a fake investment. I'm trying to do this. I'm following this. I'm making a decision that costs me something. I'm trying to accomplish something. And then if it's fake on the back end, that's a significant problem. It reminds me of, the organic labels on food, from a number of years ago. When that started coming out, people could put the word organic on foods. And the definition was, you just had to, there was no definition. Anybody could put the word organic. So people thought, hey, I'm getting something that has, no pesticides, or there came about rules that said, what does it mean when you say organic on milk, on vegetables, on other items? So that it became more defined, at least in the US. I'm not sure about in different countries in Europe or in the EU or in Asia Pacific, but there was a greater level of standardization of what it means when you say it's organic, because nobody can do massive amounts of research on every vegetable they buy every day and look at the farm and see if it's been dormant from use of pesticides for more than 5 years or whatever those elements are. It needs to be clear. And so I don't really know how to answer your question other than when things are changing and there's a focus, it takes a little while to work out whether it's regulations or standards that are used. People, for the most part, are trying to do the right thing that they see as the right thing to follow their company guidelines, for example. And that needs to be, they need to have some confidence in what's going on. In this transition period, there's going to be, if someone else, offering investments that they believe meet ESG, but if it doesn't meet someone else's standards, is it greenwashing? There could certainly be some things that would be classified as fraud. You're saying it's like, hey, this is all done by, a certain way, and it's not. Just like we don't use child labor. Well, we don't call them children. I mean, whatever those elements are, there should be, here's what it is and here's what the standard is. And it should be easy to identify at a label level, not with having to do massive due diligence, everyone having to do massive due diligence. That's horribly inefficient. So there's some way to do that, whether it's regulations or self-discipline to do that or some other type of standard. I'm not sure what the right way is, but I think their warnings are just one other element of what's going on.
The sixth story that warrants discussion is the drought impacts on China's economy. A record-breaking drought in China has triggered a nationwide alert, with southwest regions impacted most heavily and major companies forced to suspend work. Several rivers, including parts of the Yangtze, have dried up, affecting hydropower, halting shipping, and forcing businesses to temporarily suspend operations. China is on the brink of a water catastrophe. Unlike other commodities, water does not have any viable substitutes. It is essential for growing food, generating energy, and sustaining humanity. For China, water has also been crucial to the country's rapid development. Currently, China consumes 10 billion barrels of water per day, about 700 times its daily oil consumption. A multi-year drought could push the country into an outright water crisis. Such an outcome would not only have a significant effect on China's grain and electricity production, it could also induce global food and industrial materials shortage on a far greater scale than those wrought by the COVID-19 pandemic and the war in Ukraine. Craig, will this water and drought crisis add to inflationary forces and put pressure on the already squeezed global trade system?
The drought in China is notable, and I think many of us have heard. I think there's another article that you're highlighting about Germany. What's going on there? So, the drought on the Rhine is creating challenges in Germany. The hydropower in the different areas, when the water flow is lower, there's less power. The whole economy is challenged because, hey, here's a fairly cheap power source is now reduced, which means more in China, which means more coal has to burn, and it's more costly to move it and to burn it. So yes, I think these droughts can have an impact on production, impact inflation, can also contribute to tripping into an inflationary area because of the broader impact, the direct and secondary impact of energy sources.
You mentioned Germany and the fact that the drought on the Rhine is also threatening the German economy. Do you think drought, war, and supply chain bottlenecks that are affecting the German economy could nosedive towards turning it into a recession in Germany?
When we look at Western Europe, you probably saw the recent news. The UK's inflation rate exceeded 10%. We see the Russia cutting off for repairs, cutting off the supply of gas to Germany. These are significant impacts, right? The ability to transport goods on the Rhine, the heat of the summer, winter's coming where they're going to need energy. These are significant concerns, and they have a ripple economic impact onto them. So, when we look at some of the countries that have done away with nuclear power, for example, now you're reliant on, natural gas or other sources that you're dependent across the border. In this case, on Russia for fuel. That's putting the Germans in a troubling spot for that. and I know nuclear power is not popular like anywhere practically, except maybe Iran, right? There's not a big push for nuclear power. And so we have, wind, water, coal. I mean, energy is extremely important for the economies to run, for people to be healthy, for food production across the board. So these are significant earth or natural factors that are having an impact, in addition to the geopolitical factors that are intentionally impacting and exacerbating some of these minor crises to great crises.
Finally, I would like to wrap up this conversation by seeking your opinion on your choice for the biggest or the most important story of the past week, and why.
The ones that we talked about here, I don't know that any of these are the biggest story. I mean, perhaps the China influence. I mean, a lot of the themes are around China. One, Russia's inviting them into the quasi-SWIFT environment. Countries are thinking the China risk after the Taiwan tensions. We had a delegation, the Speaker of the House went and visited. That was, everything is either, a pretext for or a reason to continue to escalate tensions and have more flights, even though there were lots of flights and military activity in the Taiwan Strait. And then you have their rate change, the drought in China. I think China is probably the biggest story if we spin off of that, all of these different areas, the drought, tension with Taiwan, their general openness to trading outside of the environment. I think I'm going to have to go with that.
I'd concur with you, because interest rates, drought, water, alongside some of the other issues, including tensions with Taiwan, all of them have a cyclical effect. All of them are interconnected, and it being the world's second largest economy means that if it sneezes, it will. Most countries in the world will. I mean, if it coughs, it will make a difference. So yes, I would concur with you that the China story is something which can affect most parts of the world. And all of us, we live in now, we live in such a small and connected world that I can't think of anything else except the China story. So yes, a big thank you to you, Craig, and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.